So basically, we take a look at this. It was really a good quarter, but I like to break things out on a month-by-month basis. And if we take a look at how things shaped up, I think we'll see kind of a story presenting itself as well. January was of the 3 months, the best time period to be actually looking at, getting returns out of the market. We had a 5.97% return with about 97% of all equity and mixed equity funds up on the rise, and it was the best January that we've seen for mutual funds, equity mutual funds, since 1987. So that was quite the story. February, we had a 4.2% return, and about 96% of the universe out there actually on the plus side. And of course, in March, we had 1.34% return. So the story I guess I'm seeing here is if we take a look at what originally happened, last quarter I told you was one of the better quarters we had seen. We had positive numbers, Santa Claus rally and all that at the end of the year, and people thought they may have missed the boat. So we saw a lot of people jump back in the market and started taking advantage of that. In fact, we'll talk a little bit more of how many people actually jumped back in the market in reality when we get to Matt's piece, because I think you'll be surprised that a lot of equity investors have not jumped back in full force, but we certainly saw reasons why people wanted to jump back in, particularly focusing on what happened in January. We take a look, and basically, again, it was the best January we've seen since 1987. But why was that? The reason we saw that is we saw unemployment actually looking much better than it had in the past. The Labor Department came out with a number that said that 200,000 workers had been added to the non-farm payroll group. We saw the unemployment rate drop to 8.5%, and overall, when we were looking at the economy, we saw some good numbers. In addition, we saw the FOMC basically come out and say they're going to keep rates low until 2014. So overall, people were encouraged to get back in the market. So we saw some of the underperforming groups. India region funds, by the way, was the worst the quarter before that performer, up 20.64%. We saw commodities, precious metals up 13.69%. And of course, anytime we have very strong performance, dedicated short bias funds were in the cellar, and that's going to trend all the way through through the next month and actually for the quarter as well. And then we saw that the commodity energy funds were down 1.61%. But overall, again, a grand January as a whole. When we take a look at February, though, we had to deal with new issues. The Greek debt issue was not settled yet. We saw some saber rattling, from Iran, and then the subsequent oil rises because of kind of the nuclear power issue versus nuclear weapon issue. And I think that put people on edge. But what people looked at again, jobless claims looked much better than they had before. We saw better than expected earnings reports, and the economic data was very strong as well. So while we were seeing rising oil prices, we saw the Dow Jones Industrial Average hit a high since May 2008, climbed above 13,000 for the month. So people were now really encouraged. The stories were out there that people should probably be investing back in the market. The Dow gained 2.53%, Nasdaq was up 5.44%, but more importantly, we saw international real estate funds, some out of favor areas, up 7.72%. Diversified leverage, those people wanting to make bets on the market doing well, up 7.26%. And European region funds up 6.67%. So the story here was people really were starting to move after, I'm going to call it the baby with the bathwater funds. Those stocks that we just went away from in droves during either January or really the month of November and December, where we were basically getting rid of, at that time, the laggards. This time, again, the laggard was dedicated short bias funds, down 7.32%, and then commodity specialties. We're going to see that commodities actually took a drop. This one, commodity specialties, down 1.56%. Remember, the specialty commodity group is made up of those that are either using leverage or dedicated short bias type of focus as well. So these are kind of a unique situation, but they got clobbered throughout the periods as well. That brings us to the final month, and it was March. And this is where investors took a little bit breather. So again, I told you 5.97%, then 4.2%, and then 1.34%. This is where people actually took a step back and said, wow, we have had a fantastic quarter. Can we repeat this? Can it keep on going? And so two things happened, actually. First of all, people were concerned that S&P had come out and basically said, hey, listen, the Greek debt issue may not be over as fast as we thought it was. And secondly, when we're taking a look at it, spring breaks, there's going to be a pause here. Maybe we should pull a little bit of those hard-won profits off the table. Even though we heard, again, that the unemployment rate dropped by 227,000. The non-farm payrolls actually increased by 227,000, and the unemployment rate dropped to 8.3%. So that was really some good numbers to bank on. Here again, we saw people going after some areas that were out of favor prior to that. Financial service funds were up 5.03%, real estate funds up 4.71%, and now kind of the new interest, science and technology, something we've been seeing for quite some time. From January on, basically technology was rearing its head, and people were embracing it, 4.29%. Laggards now, though, gold down to 10.97%. Commodity precious metals down 5.71%, and commodity basic metals was down 5.36%. So here at the end, we saw kind of the story where people are saying, you know what, things are looking better. We really think that the European debt issue may be over. Of course, at the end of the month, we heard that it may not be, but we were thinking the European debt issue might be over, might be solved, and so people were less likely to be going into the safety areas or into the defensive issues, and they were willing to embrace a little bit more risk-seeking behavior, and we'll find this through the quarter as we move on. So let's go ahead and move on to the next section. That's really where we start talking about the quarter as a whole, and it was the best quarter we've seen since 1998. And again, this was off on an issue. When we're taking a look at the European debt issue, we actually had some comfort levels there. We thought it was over, maybe, but we also weakening of the dollar. So this was not surprising to see world equity funds actually rise to the top, 12.55%, and do best for the quarter. But I do want to point out that they only did best for the quarter by a few basis points. United States diversified equity funds were up to 12.32%, so they basically did very well as well. And then we had sector equity funds, which, by the way, had quite a few of the losers in the group. We'll go into detail on that, 9.41. And mixed asset funds even had a respectable 7.40%. Any of these numbers I would take for a year return, and we got that in the quarter. That is where people took a pause and a rest in March, and maybe really might have a rest going on for the next month or two. People are going to be concerned. They're looking at it. 97% of all equity and mixed asset funds were in the black. This was a strong piece. And at the top of the group, last quarter's leader, diversified leverage up 24.02%, and again, last quarter's laggard India region funds up 22.63%, and of course, technology finally gaining some legs, doing some strong returns. We'll talk a little bit more about that later. Up 20.26%, and global technology up 18.96%. So this is one of those stories where, again, risk was put back onto the portfolios in a big way. When we take a look at the dollar, what had happened, actually we saw a little weakness. We saw the pound lose about 3.28%, the euro down 3.12%, but the dollar gained against the yen, up 5.93%. Overall, gold rose 6.61%, and oil climbed 4.24%. But and I don't know if I mentioned it, we actually saw kind of a reversal, some of that trend in March as well, as oil, gave back some of those profits, and still above 100, but was coming back down towards the 100 mark as well. So I wanted to say one more thing. The Dow Jones Industrial Average, by the way, during this period of time, had its best quarter point gain, 994 points in its history, and it was the strongest first quarter return at 8.14% since 1998. So let's go ahead and move on to the individual breakout in the macro classifications. As we're taking a look, it was basically the strongest quarter that we've seen for this group since Q3 2009. So United States diversified equity funds actually did very well. Remember, I was telling you that world equity funds did edge out USD funds, but only by 23 basis points. Here's where we get into the story again. Diversified leverage fund, people willing to put on 2 times, 3 times, 1.5 times the risk, actually benefited, up 24.02%, had a grand quarter. Large cap growth fund, so up 16.26%. That was a big number. And one thing I want to point out is this group had the best and the worst leaders and laggards in the universe. Again, diversified leverage up 24.02%, dedicated short bias funds down 16.31%. So even though it's edged out by world equity funds, I consider USD pulling in some very, very strong numbers. And this is the first month in 5 that we've seen United States Diversified Equity Funds as a leader in the March during the March group, so it was the best performing macro group. And again, here we got the leaders, large cap growth equity funds, at the top of the group, and this was the best performance that they have seen, their best monthly ranking since August 2007. So again, large cap growth and technology issues certainly came into vogue, and again, the best since August 2007. So we'll talk a little bit more about the technology driver in this piece as well. And again, large cap S&P 500 funds up 3.24% for the month. They were the second best performing group as well. So we move on to the big chart that usually you can't see too well, but I think it helps people with all the abbreviations that I use as well. One thing I wanted to point out is growth. Growth was the moniker. It was basically in favor, and if you look down towards the bottom, hedge-like strategies were actually at the bottom. So we had equity market neutral, we had long-short equity funds, down towards the bottom, and not necessarily negative territory, but certainly not putting the returns that we saw in the other groups up. But again, growth, core, and value, they are segmented, from top to bottom. At the bottom, we can see growth was certainly in favor. We'll see that more in the next slide as well. In the next slide, we see that the growth funds turned 15.38%. It was probably about a greater than 300 basis point lead. It was the first quarter in 4 that we saw growth-oriented funds actually take the lead. In large cap, when we're taking a look at the large cap group, up 13.56%, that's the third quarter in 4 that they actually were the top performers. So people have been moving towards large caps, but in the past we were talking about core and value-oriented funds as people were looking for the dividend payers. But now people were looking and willing to put on a little bit more risk, so we saw a combination of both large cap and growth do well. And of course, as we said before, large cap growth funds up 16.26%, their best in quite some time. On a monthly basis, as we take a look at it for the second consecutive month, large cap funds were up 3.04%, and for the third month in a row, growth-oriented funds, and we saw that with Apple, Microsoft, and some other leading tech companies actually reporting good earnings in January, up 2.90%. So this is something that we've been watching, and we've been seeing growth make a good play for the last 3 months. Moving on to the sector equity group, this group contained 4 of the 5 funds fund classifications with negative performance. So at the bottom of the group, we see the Commodities Specialty Funds down 2.06%, gold-oriented funds. Actually, we now call them precious metal funds, down 1.72%. Commodity energy funds down 1.07%, and the commodities agriculture fund down 0.74% for the quarter. This makes sense. Thomson Reuters actually just had a summit both on food and energy and then on commodities, and basically said in the review that there was better numbers out there. In the past, commodities were on the demand. We had China growing at with fits and spurts, and now it's slowing down a little bit. And also when we get to the food, in some of the energy sectors, there was a inventory problem, and they're seeing inventories look much better at the end of the year and the beginning of the year. So this kind of makes sense to us to see a little bit of a letdown in some of these commodity areas. But on the flip side, again, risk-seeking behavior took technology funds 20.26%, global tech up 18.96%, financial services funds up 17.56%. So again, the baby with the bathwater, people coming back in, looking for values and trying to find places they can put their money, and that was one of the areas. And it certainly makes sense that they would go towards the technology area. We all heard about the grand growth from Apple, up over 50%, Skyworks, and even Seagate. When we take a look at those, we're talking 40, 50, and 60% returns for the quarter, and it's something in a little bit over a quarter actually. That's something that people have been keeping an eye on, and it certainly has carried forward for some time. And the lagging or underperforming sectors include consumer services funds up 16.79% and international real estate funds up 16.59%. So those groups did very well. And for the science and technology, I want to say it was the best ranking that we've seen science and technology funds actually have since Q4 of 2001. So people really are buying back in to the idea that technology's got some legs. We've been talking about it for ages. There has not been a significant, sustainable, #1 performing rally for technology, and this is something that we've seen here recently. For March, we see that financial services funds were up 5.03%. It was their best monthly ranking since October of 2005. And again, real estate funds up 4.71, technology up 4.29, and of course, some of the commodity related groups were at the bottom for this group as well. So again, like to just show people kind of the differences of what's up there. And at the bottom, what I was talking about, these commodities that have had fairly good increases in their inventory levels and or have been affected by the at least claimed slowing growth of China and its economy has played a little bit of havoc. And at the top, we see science and tech and those related type of funds towards the top, and out of favor financial services as well. So let's move on to the World Equity Funds group. And when we take a look at it, this is the best performing category for the quarter, World Equity Funds. And that's actually not something that we've been taking a look at for a while. It's been out of favor when we take a look at World Equity Funds. So this was something kind of new, but again, it was edged out. It edged out the group only slightly. There were no negative returns in this group, so when we compare it to the worst and the best in the USD group, we can say, listen, maybe USD actually taking away dedicated short bias funds actually outperformed the World Equity Group. But in any case, India region funds were at the top, 22.63%. International small mid-cap funds, core, up 15.05%, and Latin American funds, ironically, at the very bottom for the month is China region funds down 4.82%, India region funds down 3.99%, and Latin American funds down 2.78%. So again, we've seen this willing to move into international and more risk, and at the end of the month when we're taking risk off our portfolios, we see that these were the first that we jumped away from. So certainly that was a story as well. So the high rollers did very well for the quarter, but again started losing some luster, if you will, towards the end of March. And the global large cap growth fund, which was the best performing fund of the group for March, basically had its best rank since November of 1980. The reason I bring this up again is this is a large cap growth quarter. It's something that has moved the whole equity universe very well, is the idea of growth and large cap together. So looking at this, actually we get a little change when we're taking a look at the numbers. We see that growth actually did well, 13.09 for the international diversified equity funds, and for the global diversified equity funds, 13.55. But the difference from the USD claims that we had is a small mid were in favor, both with mid 14 and a half type of returns, while the other groups were right around 11. So large cap was not necessarily in favor in the international or global diversified equity funds matrix. And again, growth, I guess, was the name of the game for both sectors, USD and the global international groups as well. So again, this is just one of those things where we take a look at it. We see keep saying international. The India region funds, international small cap funds, and Latin American funds at the top, but of course they were at the bottom for the month, and something probably for us all to keep our eye on. Again, India region funds had just a grand return. Let's go ahead and talk about the mixed asset funds. Basically, they're up again 7.40%. It was the lowest quarterly return of the group. We also look at the risk-reward type of trade-off, and I don't think we're all surprised by that. Mixed asset target date funds 2045 was the top performer at 11.39%, and the bottom of the group was our absolute return funds, down 1.69%. Doing exactly what all these classifications basically said they'd be doing as far as a risk spectrum. What I wanted to point out here was, and we talk about this quite often, is the flows have actually been going in the mixed asset funds quite a bit. And one of the issues that we have talked about is year to date, how often mixed asset funds are used over other asset classes. Year to date, we saw in the equity funds group, we saw $32.8 billion in net new money come into this group as a whole, while we saw $3.8 billion in outflows from United States diversified equity funds. Sector equity funds took in about $3.9 billion, and world equity funds took in 6.4. So we see for this first quarter that obviously investors had a preference to go towards mixed asset funds. Now, this could be twofold, though. When we take a look at it, easily find that most people use this in their 401k plans, and we had some funding at the end of the year. So this is one of the reasons we saw a large amount of money, but it certainly doesn't explain why we see the large amount of money throughout the entire year of 2011 and then in the first quarter as well. But one of the things we wanted to point in, so it is still a major attractor of net new money and people's assets. So this brings us to the end of my talk. Basically, if you take a look here, I put in lower than expected March non-farm payrolls, 120,000, set everybody on fire. And if you look there at the bottom after but, I also have non-farm payrolls increased 120,000. So I see that both as a plus and a minus. I think we have to keep this in perspective. We've had 4 consecutive months where we've been above 200,000, and now we do 120,000. And yes, we missed expectations, but it was still positive. So let's not overblow the idea that this was still a good number and that this was probably seasonal adjustments. But again, it is still a concern and something we have to keep an eye on. Obviously, there's slowing growth in China, and of course, there's the European debt issue that keeps raising its head. And then we have an increase in oil prices. Will that be a factor this summer? And will that play on investors' extra money that they might be having in their pocketbook? We learned that personal consumption rose 0.8%. That was one of the plus things. But on the bottom side of that is, even though we have more consumption, is that being spent for gasoline, or is it being spent for other products as well? An increase in negative earnings per share pre-announcements for Q1. Basically, our brethren over at Thomson Reuters proprietary research team pointed out that so far they've had 83 negative earnings per share pre-announcements issued by corporations in Q1 2012, whereas they've only had 28 positive earnings per share pre-announcements. Now, when they take the ratio of negative to positive, which they follow quite often, they noted that this is the weakest ratio of 3.0 that they've seen since Q4 2008. That may not bode all that well for big returns coming forward in this next quarter. Again, I think investors will look at the employment rate, non-farm payrolls numbers, and they will certainly look at our profitability. Here's I want to take a step back. So on the previous slide, I was talking about flows into equity funds. And basically that was through February, because we're taking a look at our target date funds, which are often fund-to-fund structures. In our data that we collect for our Lipper U.S. fund flows, and something that Matt will talk about in more detail, we're actually not using the same universe, and this is through March 31st, but we see equity funds actually handing back about $7 billion to investors, fixed income funds taking in $82.3 billion, muni bond funds taking in $14.6, and of course money market funds losing money, about $92 billion. So with all this grand return that I was talking about, now we take a look back and scratch our heads and say, but investors were net redeemers of equity funds? Well, actually, Matt will go into greater detail on where they actually put their money in these funds. And of course, it's not told the whole thing. Mine is X ETFs, and I think Matt will show later on that ETFs were used quite popularly throughout the quarter as well. So when I take a look at the good things, again, non-farm payrolls, again, we had an increase of 120,000, and unemployment rate went down to 8.2. The 8.2, people have been saying, hey, listen, the reason they did this, some people left the market. Like I said, I think there's a seasonality issue in there. I think the number is actually pretty good. ISM Manufacturing Index rose 53.4% to 53.4 in March, while non-manufacturing fell to 56, but both are still signaling expansion. So these are numbers that I think that we can actually put our hats on and really feel comfortable with. Three things that we've been looking at. So we've been looking at demand for products. We've been looking at strong balance sheets, which has been around, and there's still a ton of cash sitting in corporations. They're going to put that back to work. But now I think the valuations are a little bit on the scary side. So I think taking a little breather, a little pause certainly is in the cards. But again, if we can show that the economics are good, that the employment rate's still continuing on, even if we have some problems, some slowing in India, and maybe even some more concerns with Europe, if we can show profitability and put that money back to work, I think that we can continue on with this rally again. Maybe a little pullback though is certainly in the cards. Well, with that, I will go ahead and turn this over to Jeff.